March 4, 1951. A bureaucratic meeting in Washington ends financial repression and accidentally creates the institutional investor class that will democratize wealth for 50 million Americans. The people in that room had absolutely no idea what they'd just done. Here's the number that tells the whole story. In the 9 years before the 1951 Accord, a dollar invested in government bonds lost 25% of its purchasing power. In the 9 years after, it gained 8%. This single shift made the 30-year pension promise actuarially possible and created America's middle-class retirement system. But nobody planned it that way. To understand how we accidentally built the greatest wealth creation machine in American history, we need to go back to 1942. World War II is raging. The Treasury needs to borrow unprecedented amounts of money to fund the war effort. So they strike a deal with the Federal Reserve. The Fed will support government bond prices by pegging yields at 2.5%. Guaranteed, no matter what. This sounds reasonable during wartime, but the peg doesn't end when the war does. It continues through 1946, 47, 48, 49, 1950. And here's where the problem emerges. Inflation comes roaring back. In 1947, inflation hits 14%. 14, while government bonds are still yielding 2.5%. Do the math. That's negative 11.5% real returns. Your money is evaporating. The Federal Reserve is trapped. To maintain that 2.5% yield cap, they have to buy government bonds. Lots of them. In 1950 alone, the Fed purchases $22 billion in government securities. $22 billion. They're printing money to buy bonds to keep yields artificially low, which creates more inflation, which makes the real returns even more negative. It's a doom loop, and here's the critical detail everyone misses. During this financial repression period, from 1942 to 1951, real interest rates were negative 60% of the time, 60%. If you're an insurance company that sold someone a life insurance policy with guaranteed returns, or a pension fund that promised workers a retirement income in 30 years, you are bleeding value every single day. Think about what this means. You're a life insurance company in 1948. You've collected premiums from middle-class families. You've promised to pay out when they die or when the policy matures. You take that money and invest it in the safest possible assets. Government bonds, Treasury securities, the bedrock of financial safety. Except those bonds are yielding 2.5%, while inflation is running at 8, 10, sometimes 14%. You are systematically losing money on a real basis. The 30-year promise you made is becoming actuarially impossible to keep. The same applies to pension funds. Corporate America is starting to offer defined benefit pensions. We'll pay you a guaranteed income for life after you retire. Beautiful promise. Except the pension fund managers take the contributions and invest them in bonds that are losing purchasing power every year. The math doesn't work. You cannot make a 30-year promise when your assets are shrinking in real terms. And here's where the inequality trap emerges. If you're wealthy, you can escape. You move money into real estate. You buy commodities. You invest in businesses. You have access to inflation hedges. But if you're middle class, if you're playing by the rules, you're stuck. Your savings are in a whole life insurance policy. Your retirement is a small pension. Your emergency fund is in savings bonds. And all of it is being quietly destroyed by negative real returns. Between 1942 and 1951, middle-class savers in insurance policies and bonds watched 30 to 40% of their purchasing power evaporate. The PEG system was functioning as a regressive wealth tax on the people who trusted the system most. By 1950, the Fed has had enough. The Korean War breaks out. Inflation is accelerating again. The Treasury wants the Fed to keep buying bonds to fund the war at low rates. The Fed says no. We cannot keep doing this. We're creating inflation. We're destroying savers. We're making long-term financial planning impossible. The fight gets ugly. It goes all the way to President Truman, and on March 4, 1951, they reach an agreement. The Treasury-Federal Reserve Accord, the Fed is released from its obligation to peg government bond yields at 2.5%. Market-determined interest rates return. The era of financial repression ends. Now here's the part that's almost unbelievable. The institutional investors initially opposed this. Insurance companies and pension funds fought against ending the peg. They preferred guaranteed low returns over the uncertainty of market volatility. They didn't understand that negative real returns were killing them. They saw 2.5% and thought that's stable, that's safe, that's predictable. They couldn't see that predictable losses are still losses. The very institutions that would benefit most from the accord opposed their own salvation. But the accord happens anyway, and the mechanism that follows is extraordinary. Once the peg is lifted, interest rates can find their market level. And with inflation moderating through the 1950s, bonds start earning positive real returns. Not spectacular returns, but positive. Your purchasing power is preserved. For the first time in a decade, long-term investing makes sense again. Watch what happens to institutional assets. Life insurance company assets, according to historical evidence, grew from $64 billion in 1950 to $207 billion by 1970. The composition shifts dramatically. They move into corporate bonds, into equities, into higher-yielding assets that are now viable because real returns are positive. They can meet their obligations again. Pension fund assets tell an even more dramatic story. By most accounts, private pension assets increased from $12 billion in 1950 to $112 billion by 1970. That's more than 9 times growth. 9 times. And this isn't just money moving around. This is new wealth being created because suddenly the defined benefit pension model works. An employer can promise you an income for life because the pension fund can actually earn returns that make the math viable over 30 years. Remember that number from the beginning. In the 9 years after the accord, $1 in government bonds gained 8% in purchasing power versus losing 25% in the 9 years before. That swing, from -25 to +8, that's the difference between a pension promise that's a lie and a pension promise that's actuarially sound. And here's where the democratization happens. Pension coverage explodes. Evidence suggests the percentage of private sector workers covered by employer pension plans rose from 25% in 1950 to 45% by 1970, 25 to 45. That's 20 percentage points of American workers who now have a path to retirement security that didn't exist before. Not because of government mandates, not because of new laws, because the financial math finally worked. But it goes deeper than just pensions. The institutional investors, now flush with assets that are actually growing in real terms, start buying equities, stocks, corporate ownership. Before the accord, institutional investors owned less than 8% of corporate equities. By 1970, historians believe they owned approximately 30%. 30% of American companies now owned on behalf of middle-class workers through their pension funds and insurance policies. Think about what this means. In 1945, if you wanted to own stock, you needed wealth, you needed capital, you needed access. The stock market was for rich people. But by 1965, if you worked for a company with a pension plan, you owned the stock market. You didn't need to understand price-to-earnings ratios. You didn't need a broker. Your pension fund owned General Electric and IBM and AT&T on your behalf. Equity ownership, the primary engine of wealth creation in a capitalist economy, had been democratized through the institutional investor class. And that institutional investor class only existed because the accord made their business model viable. The results show up in household wealth data. The median American household wealth, by most measures, increased threefold in real terms between 1950 and 1970. 3 times. And for middle-class families, pension wealth became the second largest asset after home equity. Not stocks they picked themselves, not a business they built. Pension wealth, the guaranteed income stream from an employer plan backed by institutional investors who could finally earn positive real returns. And here's the kicker. None of this was intentional. The Federal Reserve didn't fight for the accord because they wanted to create a middle-class retirement system. They wanted to control inflation to fund the Korean War without destroying the currency. The pension boom, the insurance company transformation, the democratization of equity ownership, all of it was an accidental byproduct. They wanted monetary policy independence. They got the greatest wealth creation accident in American history. Now let's talk about today, because we've seen this movie before. From 2008 to 2021, we lived through another era of financial repression, near-zero interest rates, quantitative easing, central banks buying trillions in bonds to keep yields artificially low. And once again, the institutional investors suffered, pension funds faced massive underfunding crises, insurance companies struggled to meet guaranteed returns. The same dynamics that broke the system in 1942 through 51 were breaking it again 70 years later. The Accord teaches us something crucial. When government manipulates interest rates below their market level for extended periods, institutional investors cannot function properly. And when institutional investors can't function, the primary mechanism for middle-class wealth building breaks down. This isn't about free market ideology. This is about mathematical reality. You cannot make 30-year promises when your assets earn negative real returns. You cannot democratize equity ownership when the institutions that hold equity on behalf of workers are structurally unprofitable. Market-determined interest rates aren't just about economic efficiency. They're about who gets to build wealth. Financial repression sounds technical, boring, like something only economists care about. But it's actually a question of whether the middle class can access the wealth-building tools that compound over decades. The 1951 Accord accidentally answered yes. The institutional investors it empowered became the vehicle for 50 million Americans to own homes, retire with dignity, and pass wealth to the next generation. All because someone in a bureaucratic meeting on March 4, 1951, decided the Federal Reserve should be allowed to let interest rates float. They had no idea they were building the middle class. But they were. Sometimes the most important economic transformations happen by accident. And sometimes a boring policy change in a Washington conference room matters more than 1,000 ambitious government programs. The Accord proved that when you get the incentives right, when you let markets clear, when you allow institutional investors to actually invest, wealth creation doesn't just happen for the rich. It happens for everyone who shows up to work and trusts the system to keep its promises. That's the lesson. That's what we accidentally built, and that's what we risk losing every time we think we can manipulate our way to prosperity.